Hey everyone, welcome to this explainer. Today we are taking on an absolute beast of a topic, but honestly, we're going to make it incredibly clear and, dare I say, maybe even a little fascinating. We are decoding the matrix of the U.S. tax landscape. So if you've ever felt completely overwhelmed by the surprisingly complex, overlapping layers of the United States tax system, well, you are absolutely in the right place. We're going to demystify this entire structure and map it all out. By the time we wrap up, you'll see exactly how all these moving parts fit together.
Okay, let's dive into this. Our macro to micro roadmap for today covers 5 main areas. First, why tax is not a silo. Second, the 3 levels of taxation. Third, the multi-layer example. Fourth, the 7 types of U.S. tax. And finally, high-stakes tax traps.
Section 1. Tax is not a silo.
Now, before we even glance at a single tax rate, we really need a vital mindset shift. Let me ask you, do you think tax is just for the specialists? You know, it's a remarkably common misconception. People so often treat tax like this totally isolated department that you just hand things off to at the end of the year and completely forget about. But honestly, nothing could be further from the truth.
The reality is, tax actually hides literally everywhere in your daily work. Think about it. If you're doing a financial statement review, you're dealing with ASC 740, which governs deferred tax accounting and sits right there on every single balance sheet. Working in transaction advisory, the entire structure of mergers and acquisitions is fundamentally driven by tax treatment. If you're building a financial model, your effective tax rate assumptions are going to directly dictate your projected cash flows and overall valuations. And in cash flow analysis, understanding the timing differences between book income and taxable income, well, that's the exact reason why clients' cash flow often looks completely different from their reported net income. You simply cannot confidently lead a client discussion without grasping these concepts. Tax touches absolutely every financial statement and every business decision.
Moving on to Section 2. 3 levels of taxation.
So, unlike a lot of countries that just have a single, streamlined national tax authority, the U.S. system operates kind of like a set of matryoshka nesting dolls. It's all these overlapping layers of taxation. Now, the supreme baseline here is federal taxation. This is governed by the U.S. Congress and administered by the IRS through the Internal Revenue Code. The absolute key thing to remember here is that federal tax applies uniformly across all 50 states. Whether you're in New York or Nevada, the federal rules apply to all U.S. persons and entities. The Internal Revenue Code is the ultimate source of federal tax law, and it's definitely worth noting that the 2017 Tax Cuts and Jobs Act, or TCJA, was the most massive reform we've seen at this level in about 30 years.
But, the federal level is just the outermost doll. Below that, we have a really stark contrast between state and local taxation. At the state level, which is administered by state revenue departments, you have income taxes that just swing wildly. From 0% in states like Texas and Florida, all the way up to 13.3% in California. Plus, states control the sales tax. Surprisingly to a lot of folks, there is absolutely no federal sales tax or VAT in the U.S. Then you step down another level to local taxation. Administered by city and county assessors, this is where you get the property taxes that fund local schools and even city or county income taxes, like the ones you'll run into in New York City or Philadelphia.
Which brings us to Section 3, the multi-layer example.
And this brilliantly illustrates how abstract theory collides with the real world. Imagine a standard C corporation operating out of San Francisco, California. They aren't just paying taxes to one single place. No way. They are paying 4 different authorities simultaneously. At the very top, they owe the IRS a 21% flat federal income tax. Then, the California Franchise Tax Board steps in for an 8.84% state income tax. But wait, California also wants an $800 minimum franchise tax literally just for existing. And finally, the city and county of San Francisco layers on a gross receipts tax that varies depending on your industry. So that's one business paying 4 completely different tax bills across 3 distinct levels of government. It's a lot to juggle.
Section 4. 7 types of U.S. tax.
All right, here is your rapid-fire overview of the 7 distinct tax buckets you actually need to know. You've got taxes on income and payroll, which hit entities and individuals. You have transaction taxes, like sales and excise, hitting consumers and sellers. Then you have your wealth and asset taxes, like property and estate taxes. And finally, customs duties on imports. Let's briefly break down a few of the most critical ones so we can see how they work.
Let's move to and see how this builds in practice, starting with income tax. At the federal level, individuals face progressive rates. That simply means the more you make, the higher the percentage you pay, scaling from 10% all the way up to 37%. C corporations, on the other hand, pay a flat 21% federal rate thanks to those 2017 tax reforms we talked about. But remember, pass-through entities like LLCs or S-corps actually avoid this entirely at the entity level. Their income essentially passes directly through to the owner's individual tax returns.
Next up is sales and use tax. As I mentioned a minute ago, this is a point-of-sale tax with zero federal equivalent. It is entirely a state and local game. Now, the huge danger here is a concept called nexus. If you have a client expanding their business into a brand new state, they can instantly trigger new sales tax filing obligations without any warning at all, simply by having economic activity or physical presence there. It spreads like wildfire if you aren't paying attention. You absolutely have to track this carefully.
Then we have property and excise taxes. Property tax is asset-based. It's assessed annually by counties or cities, and it's basically the massive engine that funds local schools and services. Excise tax is a little different. It's a per-unit charge that hits very specific goods like fuel, tobacco, alcohol, and firearms. Both of these taxes sort of run silently in the background of many physical business operations, and honestly, they often get overlooked in high-level strategic planning right up until they start eating into the profit margins.
Section 5. High-stakes tax traps.
So, the crucial point is, with all these layers and types of taxes, there are some incredible dangers hidden in the fine print. Just look at this, 6.2%. That single number is the Social Security payroll tax rate, which is part of FICA. It seems pretty small, right? But here is the massive trap. Payroll tax obligations are among the most strictly enforced rules in the entire tax code. If a struggling company fails to remit these taxes, the IRS can use something called the Trust Fund Recovery Penalty. This penalty completely bypasses the corporate liability shield. It pierces the corporate veil and holds the company officers personally, individually liable for those unpaid taxes out of their own personal pockets. It is a massive, terrifying trap for unsuspecting executives.
And here is another massive number, $13.61 million. For 2024, that is the federal estate and gift tax lifetime exemption per individual. Any wealth transferred below that amount is totally free from the 40% federal estate tax. But here's the catch. This historically high exemption, which was actually doubled by the 2017 TCJA, is scheduled to sunset. After 2025, unless Congress takes action, it is going to plummet right back down to roughly $7 million. For high net worth clients, this creates an incredibly urgent, high-stakes planning window that is closing fast.
Now, what's really interesting about this breakdown is how we operationalize all this knowledge. If you're part of the P&J staff, you've actually got a clear, actionable guide to mastering these concepts based specifically on your role. From juniors tackling the foundation modules in month 1, all the way up to directors mastering the full 14-part series to lead team training. This structure ensures that no matter where you sit in the organization, you are actively building the exact tax literacy you need to serve your clients effectively.
Well, we have officially mapped the matrix, which leaves us with just one critical question. Are you equipped to lead the discussion? Because as we've seen today, tax isn't just some boring compliance exercise for the accounting department. It dictates cash flow, it drives M&A valuations, and it contains high-stakes traps that can literally trigger personal liability. You have the map now. The next step is totally up to you. Will you take ownership of your tax knowledge to drive truly strategic business decisions? Thanks so much for joining me on this explainer, and keep learning.